This afternoon, the Federal Reserve is likely to reveal some form of tapering on its bond buying program that's been stimulating the economy. Eric Lascelles, chief economist with RBC Global Asset Management, is on set with us this morning. And will tapering hurt the economy, Eric?
Well, I think it is already hurting the economy. It hasn't started yet, but the markets expected it. You might have noticed interest rates, borrowing costs have already risen in a big way, and so we do see some effects. We see, for instance, mortgage refinancing down 70% from when the taper talk started. So there are some hits. I don't think it's quite enough, though, to derail this recovery. The recovery continues, just not quite as eagerly, as quickly as it has.
Should the Fed do this slowly? Or just all in and move?
Yeah, my preference would have been not to do it at all quite yet, but obviously I'm not running the show here, and so they're keen to go. I think they should go slowly, and quite frankly, it sounds like they will go fairly slowly. They're buying $85 billion of bonds a month. They'll probably chop $10 billion off that, which is a notable number, but still leaves a lot of stimulus out there. That's something that they'll taper across the full extent of this year and well into next year.
It's just not economists in the U.S. that are concerned about this tapering. People in China are concerned, people in Europe, and some of the emerging markets. How will they be hit by this?
Absolutely. Well, we've already seen borrowing costs go up, not just in the U.S., but indeed around the world. And in emerging markets like China, we've actually seen their borrowing costs go up by more than in the U.S., so the hit is especially profound there. And those countries have been more reliant than they thought on leverage and extra credit that emerged from the U.S., and as a result, they're going to slow, and in fact, they are already slowing. And we've seen some little crises spring up as well in places like India and Indonesia, so they're feeling that also.
Knowing that this is likely to happen, would you change where you would park money?
Well, I think we're right to be fairly cautious in the emerging market investment world right now. So that's somewhere that we're a bit shy on, particularly emerging market bonds. I happen to think the place to be is probably the stock market. The stock market still has some upside. It's still cheap, we think. You avoid the hit that comes from rising bond yields as well. And whether it's the U.S. or other places like Europe or Japan, where those economies are also starting to sink into this recovery, I think there's some pretty exciting prospects.
We'll leave on that note. Thank you, Eric, for stopping by.
My pleasure.